Hey there, folks. I'm Bryce Holdaway. He is Ben Kingsley. We are the hosts of the Property Couch podcast, and today we are doing a Facebook Live on why time is the secret sauce for investing. But first of all, mate, hello, how are you? It's been a while since we've done one of these.
We haven't done one for ages, Bryce. Ages.
I know. We haven't even done one since you. I didn't realise you'd moved to Mars, mate. You got a little bit of green on the screen there.
Apparently so. Well, I'm looking pretty good at my end. I don't know what you're seeing at your end. So apologies to the audience that I'm a green Martian.
Yeah, well, mate, arguably giving you a little bit of colour, mate. So it's looking good, black and white on yourself. Hey, mate, we're going to talk about time as the secret sauce for investing. We have a launch this week of a special opportunity that we want to talk about a bit later on. But before we get there, we've got some teaching to do today. So I'm going to try and share my screen on this Facebook Live. The stick will certainly let me know if it's not working, but you might be able to help me out, Ben. But time is the secret sauce. Can you see that
I can see that. Are we going to full presentation screen, or we're just going to roll with this baby?
No, we're going to go full presentation like that, mate. So there we go. Hey, Ben, we're going to talk about the power of compounding, and Warren Buffett is quoted regularly, right? And rightly so, because the amount of money that he started with at the very beginning, no silver spoon, to where he currently is in net wealth is enormous, right? But here's a fun fact. If he is widely regarded as that most successful investor, 99% of Warren Buffett's wealth was earned after his 50th birthday. Ben, I reckon that would blow a few people's hair back to think that, this richest man who's been investing for some time, most of it's been done after his 50th birthday. It's significant, right?
It's incredible. 58.5 billion. That's crazy.
Yes. It's unbelievable. But
do you know the story about the Othmers who were neighbours of his?
No, go on.
So when he first started Berkshire Hathaway, because Berkshire Hathaway was actually, if I get it correctly, I'm just trying to recall whether, I read this about a decade, maybe 2 decades ago. That was a clothing or fabrics company. He took that over because he did the numbers on it, thought he could turn it around, whatever. But anyway, long story short is I think the Othmers, who are friends of the family, invested what was a reasonable amount of sum. I think it was something like sort of $15,000 back in 1967. If I'm getting, please fact check me, anyone on the comments there if anyone knows this story. But you fast forward to the fortune that they currently have in Berkshire Hathaway, and my understanding is it's in excess of $800 million. Ooh. So he's turned that. So imagine if your neighbour was one of the world's best investors and he says, look, I've got this little business that I'm about to invest in. Can you find 15? And again, 15 would have been, that was probably the price of a house, a reasonable house at that time in 1967. So anyway, they backed him, and it's delivered in spades, Bryce. Delivered in spades, the power of compound.
It's definitely delivered in spades. We'd love to hear in the comments if you've got any questions about compounding, if you've got any Warren Buffett stories, if you've actually got your own experience where you've been the benefit of compounding. We want you to leave some comments in. And Ben, we're actually got a podcast this week where we're going to talk about this very thing. So we are looking for some really great questions, and we want people to contribute. So if you have a question, let us know. Don't be shy. We would love to address it. But I think what's really impactful about this particular screen, Ben, is the fact that at the end you can see that exponential tick. It's the hockey stick, and the amount of growth that you get at the end compared to what you had at the beginning. You're going to touch on this in more depth shortly, but that is the power of why time is the secret sauce, and that's what we're talking about today. So if we go on here, people have seen, like, if you've read any books, if you've looked at any literature, Ben, you've seen one of these tables, right?
Yes.
If you've been in Jan Summers software, if you've got your own Excel spreadsheet, you've done this, and basically this is no different. $600,000 property, 7% compounding growth, Ben, which is just under a 10-year doubling cycle. It's 10 and a bit years. Your 600 become 1.2.
And so 2. Yep.
So you go here at the end of year 1, it's worth $642,000, great. And then all the way down to year 10, it's worth $1.18 million, and you think this is pretty cool. But if you then hang on for another 10 years, you can see at the end of year 20, it's worth 2.3. So it's not bad from a starting point of 600. But then if you go to the third column and you wait for the next 10 years, you'll see that that same $600,000 property, if you still held it and it grew at 7% per annum, would be worth $4.5 million. And so for anyone, Ben, and you might remember back in way back when you were playing with spreadsheets before you actually bought an investment property, this was really powerful stuff, right? Seeing what it could do. But it's on paper where you think, oh yeah, no problem. But it's this next graphic that we really want to labor on and spend some time on, where this data really comes to life. Because what you can see here, Ben, is a story of 3 decades. So let us know what your observations are here.
Yeah, I mean, we've talked about this as being like a big, heavy Cab Sav great red wine, right? The more you put it on the cellar and you just let it sit there and it just does its amazing thing and it turns into a beautiful, magical drinking wine in 20 or 30 years time from now, right? That's what the classics do. Well, we also know this of property. So in this particular example, here's the example of that $600,000 property, 7%, lineal line growth. So remember, we know we don't always get it served up in this type of time frame, but you do see that sort of lineal line growing. So after 30 years, you can see in that first decade, we received 14% of the overall return as we measured at against the end of the third decade. We received 29% of the portion of that gain in the second decade, where the capital growth moved from 580,000 to 1.1. But that third decade, it just supercharges itself, where we start to see this amazing power of compound, where we get $2.245 million of capital value, or 57% of the total return is occurring with you just maintaining that property, and depending if it's your owner occupied home or from an investment point of view, a magical investment, which, don't forget, Bryce, you're also getting an incredible amount of rental returns. Like, you get to live off the cash flow that's also coming off that asset as well, even if it's only maybe a 1.9% rental yield. I've been pretty happy with that price in terms of what I think
it'll cover the original debt, Ben, if you haven't escalated. Hey, let's labour on that. 57% of a 30-year growth happens in the third decade. And it gets mind-blowing. We're going to show you what happens if you hold it for the fourth decade, right? But so the important point here is the capital growth in the first decade, 580,000. That's a lot of money for a lot of people that only have super balances that exceed that, Ben. So that is a lot of money, but it actually it becomes small when you compare it to actually holding it over the journey. So it's an important slide, and it's one of the reasons why we always say that property investing is hold it for the long term. It's one of our mantras on the Property Couch, Ben. Buy the right property, correctly finance it, and hold it for the long term. And the reason we're saying hold it for the long term is because there is so much incredible power in the back end of holding these assets. Anyone who's held assets in the last couple of years, Ben, that's seen an incredible rise in values, they would have seen an enormous amount of the heavy lifting done at that point. So the cycles aren't linear. So you'll see on this previous slide how it's beautifully linear, which is how it's always presented in theory fashion. But what we do know in practice is it's not linear. But if you play the game long enough, you will see these wonderful swings in your favor. But the amount of times that you and I get to talk to people and they want to play a speculative game of being in and out under a decade, or we're trying to say to you, not only do we want you to not be in and out under a decade, we want you to actually hold it for at least a couple, and ideally for a few. So it is a wonderfully powerful slide and a wonderfully powerful reflection on anyone who's been investing in property. So in the comments, I want to see, has anyone actually held a property for multiple decades? And if you have, how many decades? and have you seen the power of that happening in your own portfolio, Ben? So it is. There's some wisdom there, right?
There is a lot of wisdom. I mean, I even think about when I bought that property in Bundoora, that big mistake that I made, the one that I sold. I paid $120,000 for that property in, I think it was 92. And now that's $1 million property, and it really hasn't had much done to it. I know that because it's across the road from where my brother lives and where I grew up. He bought the house that we grew up in from mum and dad. So I can see that, looking at those decades, and I remember when my mum and dad bought their property in Bundoora there in Victoria, Melbourne, Victoria, they paid $14,000 for a house and land package price. And I think that was 1970, I think 72 or 73 we moved into that property. Mm-hmm. So that just gives you some context in terms of how time does an incredible amount of heavy lifting in returns to. And when you get to these significant numbers, there was another stat, Bryce, and again, I'll probably butcher this one, but we were talking about sort of 3 or 4 years ago, I think it was, where the first company, I think it was Apple, got to $1 trillion valuation. Yeah. And it sort of took them 27 years or something like that to get to 1 trillion, and it took 18 months to get to 2 trillion. This is what happens when you execute on those types of investments. They just continue to do amazing things in terms of land value appreciation. You've also got to remember here, again, part of the teaching that we want to do is inflation is part of this story. So property is an excellent inflation hedge if you're in the asset. So in other words, if you own the asset, that is meaning that the cost, the cost is going up. Now, let's say if over that time period, inflation has been 3% of that growth, well, you've been able to benefit from that. Now, if you want to then downsize or retire debt or whatever, you still are doing a very, very good job in that inflation hedge in terms of being able to get out of it. Now, those people who waited a time period, let's say they didn't start until a decade later, they've got to assume that the value of that asset will continue to grow because inflation is a component of that as well. So that's why we've always encouraged the soonest you can afford to get into the market and the longer that you stay in the market looks after you pretty well when it comes to Australian residential property, Bryce.
It does, and that's a good point because we've got a comment in here from Mark that says paid $500K in Philadelphia 15 years ago, now worth $800. Would have liked to have seen more growth. And then we've got one also from Patrick that said purchased an investment property, 2-bedroom apartment 10 years ago, but has only achieved 5% annual growth with flat rental growth. So there's a couple of comments around. So it's important to say this is not a story for every single property, and actually going forward, asset selection is going to be more important than ever. We've documented that a lot on the podcast, but a rising tide lifting all ships isn't going to be part of the story going forward. We've got Phil Stephen here said it's only been in for 1 decade. Alice said, unfortunately, I've only been alive for 3 decades. So it's a good starting point, Alice, that you can get in and see what happens after the next 3 decades. Kevin has said 15 years for the PPOR. And Doug Slater, here's a good question, Doug, around is it realistic to assume that property values could continue to rise 7% on average over the long term? We get that a lot. We might actually address that if we can at the end, Ben, and if not, we will definitely cover it in our podcast this week that we do every week, Ben, on Thursday. That comes out around 3 o'clock Australian Eastern Standard Time. Well, it's actually daylight time now, isn't it? Hey, I then had a little look, Ben, with you. We went and had a little poke around, and we thought, well, okay, that's good with practice. That's good with theory. Does it actually work in practice? So went and found a little property in Yarraville on 266 square metres. It's only a 2-bedroom, typical of the area in Yarraville, which is a working class area that's gentrified heavily. So what I did is I went and cut out from the database to see what the sales had done. You can see there's a track record, so a number of sales across 4 decades here, Ben.
Yep.
So what we've done is we've tracked just across 2 periods. So we're going from 1984 to approximately 10 years later, which is 92.
$34,000 in 1984. Yep.
Yep. But then if you had held it for another 2 decades, what the difference would be. So you can see from 84 to 92, it grew 71,000. But from 92 to 2022, it grew 920,000. So importantly here, if you stuck around for the journey on this particular property, which isn't actually fiction, it's actually real. This happened. These are transactions that happened over time. You'll see that inside, Ben, I haven't zeroed in on these photos, but they're pretty original. So it's not like it's benefited from a renovation or anything like that. It stayed pretty original, probably just some maintenance. You can see that hanging around for the second part of the journey meant you got 84% of a total growth from 34,000 to $1,025,000 of $991,000. That's a CAGR of 9.38. Now, for those people who don't know what a CAGR is, Ben, it is the compound annual growth rate, 9.38% on average each and every year, Ben. So that's not a work of fiction, Ben. That's something that's happened.
Yeah, look, I mean, this is why we talk about the fundamentals of property. Now, what's happened there is obviously Yarraville has a lot of character properties, and it was certainly a workers area in the early 70s and into the 80s and 90s, and gentrified close to the CBD, sort of 5 to 7 kilometres out from the CBD, and it's really benefited from the next generation of Gen Xers who have come into the suburb, made it cool and gentrified it, and a lot of money has come in, and that money is obviously being invested into wanting to get into that market. So it's a classic case of human interest, human behaviour at play, and the broader demographic of those people who are able to come in and afford it, which comes back to that question that was being asked around, is it sustainable that this is going to keep growing at 9.38%? Like, when you start saying, well, how does that work? So that's sold there for $1,025,000, but I just can never see that getting to a $4 million asset, right? I mean, is it really going to go from $1 million to $4 million over the next 2 or 3 decades? That's hard to see. And this is something that does happen in terms of people's perception of the cost of things over time. Like we don't notice the subtlety changes of things that are costing us a little bit over time, but when we look back on it, like for bread or a bag of chips or a bag of lollies, 20 cents now, $3 or what, all of those things do change. So as I said, some of that has got to do with just the cost of the materials and what's going in them, and the other part of it has got to do with the fundamental desire and ability to actually go in and live in those particular locations. And this is a good case study, but we also heard from some of the people in this Facebook Live talking about hasn't perfectly happened for me. My growth story has been 5%. My growth story has been lower than that. The rents haven't gone up, and that is a product of the longer term demand and supply, and in a lot of cases that could have resulted in additional supply coming into the market, deterioration of demand for that type of asset. We know that the pandemic has seen a change in terms of want for that extra bedroom and potentially that backyard when we went through a series of lockdowns. Will that continue? Because we know that the disparity between houses and units has never been greater. But I suspect as we move through this pandemic into an endemic, that things will change, and city living and apartment living potentially could come back into vogue, and we might see some of those unit markets doing better than what they've done over the last sort of 10 or so years as part of that supply story. So that's still to play out. We've got to see a change in people's behaviour about wanting to live back in those things, because remember, 70% are usually owner-occupied and 30% are investors. So you want to make sure that you've got an asset that's got strong owner-occupier appeal. Has been a big part of this story. And then we're also talking here about the land to asset ratio, which is really that 200 66 square metres of dirt, is in a prized location now, and people are willing to pay a premium into that particular market price.
Yeah, well, if we go back to the slide here too, Ben, and we talk about the 4.5 million, I said that before. Often people go, yeah, that sounds good on paper. We can't imagine that happening. Well, I'm glad you asked that, because if you have a look at this example in Fitzroy North, have a look back in 1980, Ben, it was $119,000. And if you just by comparison, it was a little more expensive than what it cost for Yarraville. So it was 3, 4, almost 4 times the amount. But on a similar CAGR, compound annual growth rate of 9.73, have a look at what's happened here. You've got 4 decades.
Incredible.
It is mind-blowing what's happened here, because the total growth over those 4 decades, because you've got 1980 where it was $119,000, there is not a single person in that suburb who would ever have thought that a property in this suburb would be worth 4.88 million. It would have just blown their hair back. It would have boggled their mind. And yet here we are, history proving, again, this is not a work of fiction. This has actually happened. This is what's happened on this particular property. And excuse me, and it's not an unusual case. Or you can go through lots of properties and see this is the case. And if you can go far enough back to see, it is an amazing exercise to look at what that's done. But from 1980 to 2000, that 20-year period of time, it grew almost $750,000. But in the next 20 years, it grew 4 million. So as a percentage of the total growth over that whole period, 16% of it happened in the first 20 years, and 84% of it happened. 84% of it, folks, happened in the second part. So in the second 20-year period. So if you're wondering if we are trying to reinforce the point that holding long-term is the secret sauce, you'd be right. And quite often we will have someone who has bought an investment property, and we are never really wanting to have an assessment where they haven't held it for longer than 10 years, because anything prior to that for us is just, it's not worth getting into the conversation, because here we are proving time and time again that the longer you can hold it, the better it'll be. And as Ben said before, the rent will get to a point where you'll get to break even, particularly if you're negative gearing these properties, and then you'll move into a surplus period, and then you're relying on that surplus period to provide you with the lifestyle design, so that you only need to get 3 to 5 of these investment properties in your portfolio. Then you can actually fund a lifestyle, hold on to it for the long term. Don't sell the goose that lays the golden egg. And if you set it up correctly, it becomes generational wealth that you can pass on to your heirs and their heirs, because it really just provides a capital base for you to get some cash flow that provides the funds to create the lifestyle you're chasing.
Now, look, $119,000 would have been a fair amount of money for an inner city property back in 1980, considering, you were probably buying, as I said, properties out in the suburbs for half of that value by, that sort of time frame. One of the other interesting things with this asset, because we want to also acknowledge that it looks really well presented. There's probably been some work done inside of it, but you can see there it's on 593 square metres of dirt. You could put 4 different houses, like 4 different sort of freestanding single-fronted homes on that amount of dirt. And that's why you are seeing that, if this doesn't ring true about the importance of land in these scarcely held mature areas and the quality of the asset that you're buying, the owner-occupier appeal, the status that comes with that in these inner city areas, the lifestyle that's generated from these particular things. I mean, you imagine if you just bought that one, Bryce, right? Like, you don't need 3 or 4 of them. You've got $100,000 passive income comfortably in terms of the rent you're taking off the table. Imagine if you had it on Airbnb, you'd probably get double. Then you've got, but you're also banking a total growth return of 4,761,000. Now, I'm wondering if you're that person who sold in November of 2000 going, damn it.
Yeah. Yes.
It's like, okay, so I bought it at 867. I sold it there. I'm pumping the chests. I've done all right. All right. I've basically gone from 119 to 867. Look, that is the big story of what we're about here. Now, again, not every property is going to turn from that into a $4 million property. and have a CAGR at that level. We were talking back, Bryce, if you go back to the table, you can see, that was 7%, right? Mm-hmm. And that was valued at a 600,000. So you can see the power of an additional 1 or 2% compounding over the course of that period of time, and it is transformational. So, but I want to still address some other questions that we've had around the long-term return. There's a lot of papers that have been done around what is the median value and how does that move on average every year. So the consensus is that sits between 6 and 7% is a rough rule of thumb. So if you're getting sort of anything above 7%, you're doing pretty well. I've read some papers from some RBA pricing investigations about the impact of interest rates and what sort of capital growth return you get when rates drop. And they were sort of talking about 6.25 to 6.5 depending on the city and area. And of course, when you get into some towns, regional towns, you still run a bit of a risk in terms of if they're single industry towns that those towns could die off. And of course, when you're dying off, the residential land in those towns is worth very little. So again, it's a precautionary note to looking at not only Australian real estate and the value of land, because we can talk about Tokyo and we can talk about those other markets where, square meters of dirt in downtown Tokyo, square meters of dirt in downtown Sydney, et cetera, has a premium associated with that. So we don't want to lose sight of the fact that land to asset ratio plays a role. We don't want to also discount the fact that owner-occupier appeal and character and charm on these quality assets also plays a role in achieving a really great result at sale. And we don't want to also, think that median values are a good gauge. They're a rough instrument at best. So I'm really pleased that we're able to get, 2 illustrations of properties that have shown that, it's possible.
Folks, if you've got any stories to share in the comments, let us know. If you've had any experience with investing through multiple decades, we'd love to know. What questions do you have? Ben and I have got a podcast this week. We are going to answer as many questions as we can and cover this item. But Ben, I guess the important thing here, and as we reflect on what you're just talking about, is if someone says, "Oh, look, I don't feel confident it's going to grow at 7%, and I feel it's only 6 or 5 or 4." Go and do the exercise and put it at whatever growth rate you're comfortable, and just still see the percentages that we're talking about are still relevant no matter what percentage you put it at. And I think that's really important. And a couple of things. There's a couple of questions there. I don't necessarily think that 7% is going to be the norm. I do think that you have to be very good at asset selection to get some of these things, but I think often people go, well, I can't see it becoming 4 million, boys, because income isn't going to be able to allow that. Well, not everyone buys properties fully funded through debt. Some people buy it through equity. Some people buy, whether it's cash or some other assets. So the idea that property can't go up just because there's a ceiling on incomes, which means they can't borrow, is only assuming that people buy properties fully funded. Now, at the moment, according to CoreLogic, Ben, I don't know the latest today, but it usually hovers around somewhere between 25 to early 30% LVR across the entire country. When you've got a multiple $1 trillion asset, 7 trillion, maybe 8, approaching 8 trillion now. So please do not lose sight of the fact that not every single...
It's actually 9 trillion now, Bryce. It's 9 trillion. Now, this is that classic case again, rising tide lifting all ships. We're actually past that number, right? Because
quickly through the pandemic.
Yeah, but I like your point. I mean, I heard a story from a podcast I was listening to. $70 trillion of wealth is being passed from baby boomers in the US down to their Gen X and Gen Y family members. So coming back to your point, now I haven't seen the data. Has anyone seen any data in Australia? Let us know in the chat if you've heard a data story about the trillions of dollars that are going to pass down from the baby boomer generation to Gen X, Gen Y. that is going to potentially give them a windfall to be able to, have maybe an inheritance of $500,000, an inheritance of $1 million, an inheritance of $2 million. So all of a sudden, buying that $4 million property with an inheritance of $2 million means I also kick in the other property that I own. So I've now got a $450,000 loan against the $4 million asset. And that's very fortunate for those people who are going to be in a position where, that generation, the baby boomer generation, have built up that wealth and that nest egg to pass on as part of that legacy. Because it really is going to be, and I saw also something recently where the ANZ did some analysis on the wage growth of the top quartile, the mid-range, and the lower socio-demographic. And it's a classic case also is that the people in higher skilled jobs and are in demand jobs, their wages have been growing exponentially compared to the minimum wage of certain jobs. So we've seen obviously marketplaces that have been impacted from things like the bars and restaurants and hospitality workers who are getting maybe call it $19 to $25 an hour. But you're also seeing a world shortage of obviously coders and developers and IT experts, and we're hearing stories of wage growth of 40% in those industries. Now, again, this is why we keep coming back to this story of there will be people who will have that momentum, and 20 to 30, 40% of those people will be able to afford to put pressure on the finite stock that is in these inner city markets, these prestige, these signature, these status markets. And that really bodes well for those particular markets to do quite well over the long term. When you put all of that combination together, there's going to be tension, and some of them are being knocked down and duplexes are being built, some of them are being knocked down and small developments are being built. So the existing freestanding, character charming property on a good parcel of dirt becomes rarer and rarer, and that's why we've always talked about those particular assets doing very, very well when we refer to quality assets and investment grade properties. Now, again, not everyone can afford them. We're going to see similar trends in middle ring suburbs where there has been full utilisation of land, and that again proves the point that if you're in a nice middle ring suburb with good infrastructure and amenity, there's going to be tension on people wanting to buy your property based on their affordability metric and a level of what they can afford to get in as well. So it does bode well for a pretty amazing line of sight on what's going to happen in the property market in Australia over the course of the next 20 to 30 years.
Well said, Ben. I think it's important for people to always remember that in any one suburb, there is a range of profiles where people have their house fully paid off to people who have it fully hocked up to the eyeballs, and everywhere in between on the spectrum. So to assume that every property in every suburb is super reliant on income for it to be a precursor of its growth. It's actually a leading indicator, but it's not an indicator that prices can't continue to grow. Hey Ben, you and I have put together a course. We're really proud of it because we are uber passionate. We walk the talk. We buy investment properties ourselves. We help our clients buy investment properties. We want to help as many people as possible. And so we wanted to provide a course that was affordable, within reach of everyone, not people that need to pay tens of thousands of dollars that most courses and mentoring packages come for. So we've put video teaching in place to show you what property to buy, where to put the finance together, how to do $1,000 a week, $2,000 a week, $3,000 a week. We've got case studies to show you, and it's on demand, it's video so you can see it, Ben. So this week we are making a very special offer for anyone who wants to get access to that course. We only do this once a year, Ben. This is it. We've got a 7-day window for people to take advantage of an offer. We've discounted it significantly. And I just want to quickly show one of our students, Ben, who has gone through the course, applied it, and has the benefit of seeing what we're talking about here in terms of holding properties for the long term. So let's have a little listen to one of our students on what they think about our Start and Build course.
Yeah, it's really good. They really explain all of the terms in this course. So you're really, you're armed with the right tools that you need to succeed in your property investment journey. I thought it was very, very valuable.
The true, goal of the course is that it gives you a fundamental understanding of the basics, the true drivers for positive wealth success.
If you were just starting out, I think that would be amazing you definitely get heaps from it.
Definitely do start and build course, 100%. It'll set you on the right track, set you on the right path. It'll open up your mind onto how you really should be doing things.
That moment when your motivation actually seems to die down, or when your goals actually get derailed, the process that Ben and Bryce discussed have helped me in particular to get back and clear up the vision.
I've always seen the big differences between people that have succeeded and not succeeded. And the one thing that I think differentiates the two are people that just try something. The people that don't really succeed are the ones that stop or don't try at all. Just do it. Think of Nike. Just do it. That's it.
There you have it, Ben. There's just some of the students that have been through our Start and Build course and what they think of it. So we're super proud of it. I'm just going to put a little link here so you can actually see. Go to that link now. You will actually be able to get access to the very special offer that we've made, Ben. It's very, very affordable for most people. And I would be super excited to see as many students as we can enroll for that course so that we can support them throughout the year and they can make this year their best yet. They can set up the property portfolio, Ben, so that when they have the first decade, the second decade, and the third decade, they can see this as a defining point to remind them that the sooner they start, the better, so that they can have you and I mentor. So as we work towards wrapping this up, Ben, I'm just going to share my screen because you had a point that you wanted to highlight within this graph where the actual dollar amount versus the percentage dollar amount, the differences between the early part of the journey and the latter part of the journey.
Yeah, I think it comes back to, when you first buy a property and you think about the rental yield that you're getting and the growth that you might get. When we then calculate future rental yield, we calculate it on the future value of the asset. But I think it's just also another little great way to highlight that you bank dollars, you don't bank percentage gains. So let's talk
hang on. That's a wisdom bomb. You don't bank percentages, you bank actual dollars.
You bank dollars. I mean, percentages are nice. They're bragging rights for some, but you bank dollars. So from year 1 to year 2, quick calculation there from the 642 to the 686. You see that's $44,940. So that's been the paper gain that you've had over that time, give or take. What's happened in the market, up or down. You're not selling, so it doesn't really matter. But let's fast track to from year 28 to year 29. The increase is $279,000. Then from 29 to 30, it's effectively $300,000, right? It's $298,799. So I always then say, gee, that's pretty incredible. Imagine if I bought a $300,000 property and I wanted to get $300,000 in growth. That's got to grow at 100%. So, so even growing at 50%, I'm going to get nowhere near the value return that I'm going to get in holding this property over the long term. So just remember, you do ultimately bank the dollars. You don't necessarily bank the percentages. So there'll be plenty of people who will tell you over the journey, this property did 42% in this time period. Well, that could be true, but it might revert back to its mean because it's a booming market or whatever it is. I always say I'm going to play the percentages. It's one of the greatest things that I've ever done as an investor. Every time I go outside of playing the percentages and the probabilities, my returns aren't as great. When I try for my moonshots, they don't often work. But when I come back to property and I play the percentages and I think about where the demand is and the value of the land, I get the ultimate result, and I'm the beneficiary of that downstream in terms of a multi-million-dollar property portfolio on the back of that. So with the passive income to boot. So that just gives you some example of, yep, great, I had 100% return, $1 into 2, that's nice. But if you get 100% return on $4 million, you'll get my ears pricked. But ultimately, that's what we're talking about here. Long-term, time in the game, and making sure you're banking the dollars. And I'm sure the rental yield coming off that property at 4.6 million when originally you paid 642,000 for it, you'll see a huge amount of passive income coming in off that property as well.
Well, as you paid 600,000, that's your first year's growth there, Ben. So but well said. You folks, if that didn't land, you bank the dollars, you don't bank the percentages, which is unbelievably true, and that should land as well. So there you go, folks. We want to encourage you to go to this link here, get access to that course. It's heavily discounted. Once this week's over, it'll revert back to its original price, Ben, which is about 60% more. 40%. So it'll go. It's currently 60% of its price. It's you should take advantage of it. 12 hours of teaching. You and I, a mentor. We walk through what to buy, where to buy, how to finance it, and then we show you some case studies on what to do that. So, Ben, I just want to thank everyone for all their great questions on the Facebook Live as we wrap this up. We are going to cover in our podcast, like we do every week, Ben, we're going to cover all the surplus questions here that relate to this topic. So I want you to tune in to the Property Couch this Thursday at 3 p.m. So all you need to do, Ben, is go to thepropertycouch.com.au.
Bye for now.